The 60-40 portfolio is dead. At least that's according to today's expert. From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that compound into big outcomes. I'm Bryce, and today with my co-host Ren, we're unpacking the rise of alternative investments and how all advisors can build a balanced portfolio that includes alternative assets. Ren, good to be with you.
Bryce, good to be with you. Excited for this one. This topic is definitely front of mind for most investors and most advisors. The unbelievable rise of the alternative asset classes, private equity, now private credit, but also just the vast range of alternative assets that have become, a little bit more accessible. The minimums have come down a bit. Maybe they've gone from illiquid to semi-liquid.
Yeah.
It has really opened up a world of opportunity. But with that world of opportunity comes questions about how we navigate it and how we build portfolios around it. So to help us answer those questions, today we're going to be speaking to Felicity Walsh. She's the Managing Director of Australia and New Zealand at Franklin Templeton. She's really focused on alternative assets, and she's going to help us understand it today.
Yeah, I finished this interview really excited about the opportunities to come. We spend the last section of the interview talking about the trends that she expects to see play out over the next sort of 5 years or so, and how portfolios might be looking over the next decade. And the opportunity to invest in almost anything through tokenized systems is, it's going to be awesome. So I was pretty excited.
I think that was something that's interesting. Like we've said it before on this show, we'll say it again, but watching what's happening in the US is a really good guide of what will eventually come to Australia. They're just, the financial markets and technological adoption generally are just ahead of where we are. And Franklin Templeton, a large financial institution, getting involved in the tokenization of assets and using some of that crypto technology to apply to more traditional financial asset classes, I think is a really interesting use case. It's something that she's seeing her US colleagues do more and more, and it's something that you would expect to come to Australia at some point. And what that will mean in terms of like increasing accessibility and liquidity on some of these asset classes is it's going to be
even traditional exchange disruption.
Yes, yeah, that will be interesting as well.
Time.
But like the tokenization of the Sydney residential property market is just gonna that's gonna
be wild.
It's gonna change how Australians invest, and maybe not in a good way, but as advisors, as investors, we can't fight the change.
No.
We have to understand the change, swim with the tide, and maximize our returns as markets change.
That's it.
This interview will be a really useful one when you're thinking about building client portfolios for the next few decades.
Absolutely. This interview was recorded at the Morningstar Investment Conference, so thank you to Morningstar for having us. But a huge thank you goes to our launch partners here at Basis Points, SIBO, Milford and Orbis Investments. Without those three, we wouldn't be able to keep the content here free and accessible for all of you. So a huge thank you to them.
And a reminder that all episodes of Basis Points have been accredited by the Financial Advice Association of Australia for CPD points. So head to the link in the YouTube description or podcast show notes, complete the quiz, and we will send you your certificate. All right, Bryce, well, with that said, let's get to our conversation with Felicity Walsh, Managing Director, Australia and New Zealand at Franklin Templeton.
Felicity, welcome to Basis Points.
Thank you for having me.
So we've got to start with this. Is the 60-40 portfolio dead?
Is it dead? I'm not sure when it was last alive, actually. Look, in my mind, it's dead, buried, forgotten. Probably a little while ago. I guess, look, a lot of the investors I work with very much think about portfolios broken down into at least 3 buckets of equities, fixed income, and alternatives. Once you start getting into that alternatives bucket, you then break that down into, you could have 20 other buckets under there. So really, how I think of it, absolutely the traditional 60-40. There's plenty of reasons for this. We can come on to them. But yeah, there's more going on in the world. There's more dimensions to how allocators can invest than there were historically when all the research was done on, this is efficient frontiers, and this is what a 60-40 should look like, and this is what you get. So, yeah, very much dead.
Nice. Gone and forgotten.
And when we were researching for this interview, we saw some Franklin Templeton research that suggested that now is a pretty pivotal moment in adoption of alternatives in private markets. What's some of the research and some of the data that sort of says that now is the time?
Yeah, we absolutely think that. Number of really key drivers. I guess part of it is the economic environment we're in. We're in a higher rate environment than we've been in for kind of 20 odd years. We're in a higher inflationary environment than we've been in. Therefore, we're dealing with different economic scenarios that affect our portfolios differently to what they have been in the kind of broadly the last kind of 20-year period since the GFC. So that's one thing. There's a big part around geopolitics and all of the noise that's going on there, creating a huge amount of volatility and uncertainty in markets. Volatility and uncertainty are really bad for kind of traditional directional strategy. So things like, just your traditional equities. If you don't know what direction things are going in, you're making a pretty big bet to go this way or that. Within alternatives, within liquid alternatives, hedge fund type strategies, you've got many levers to pull, so you can actually bet on winners and losers, and you can win on both sides. So you don't need to know the directionality. You can play a more kind of market neutral game. So I think on that liquid alternatives hedge fund side, it just makes total sense when you've got volatile, uncertain markets. I think on the private market side, part of the reason why we would say that now is a really opportune time is partly just because there are now available options to invest in private markets outside of your traditional players who would have been your institutional investors or really large allocators who would traditionally have played there. So there's just more product structure. There's been a lot of evolution in building structures around private market strategies that make them more accessible to a broader audience, and particularly a kind of in the Australian market, a wholesale audience. So I think that's really key. I think also just how, alternatives have become so much more mainstream. I think there's so much more familiarity with alternatives, whether they're hedge funds, liquid alternatives, or private market alternatives. So I think that educational process that's been long and slow is finally getting there, and I think the recognition that to build a really diversified, robust, resilient portfolio, you have to have more drivers than your equity, essentially, relying on your equity risk.
Yeah. You say the education process has been long and slow, but I imagine that, some of the returns that particularly private equity has been generating, over the last decade, call it, has accelerated the educational process.
Yep.
How has the conversation with advisors changed from, say, a decade ago to now when you start talking about alternatives?
Yeah, absolutely. And private equity over the last 10 years has returned around kind of 16% per annum. That's about the level that we're looking at. So, that's a really significant return. If we think about private equity, you've used that example, let's use private equity. In days gone by, companies would, they'd start off as private companies. They'd grow to a certain scale, and then they would get themselves listed. That would be, that's their big kind of, we need to get to listing. That's when we get our payday. And then they drop into all the indices and become a kind of public market, part of the public markets. What we've seen over the last 5 or 10 years is companies going public a lot later, or not going, really holding off going public. And there's a bunch of reasons for that. Primarily just access to capital for private companies has been really easy to come by, and this is partly due to the amount of money, particularly from institutional investors, that has flowed into private equity. So there's been plenty of money for them, plenty of investment for them. They haven't had to go to the public markets to get that investment. And then, of course, there's regulation complexity is only going in one direction. So if you're a public company and you can report to your group, you have proper structures there, but you are not having to do the reporting to market, the board packs, the scrutiny, the short-termism that you get from the public market. Just means that those companies are staying private for a lot longer. So back to the original question, I've gone a bit off track, I think 10 years ago, investors may well have been investing in some of these private markets. They just happen to be public at that point. Now they're staying private for longer, so now you actually have to go into a different vehicle. You can't get that access through your public equity exposure. So that's part of it. And then I guess, the other part is just familiarity. And I think part of that is just how the world has evolved and how much access all of us now have to podcasts like this, to be able to educate ourselves and understand markets beyond just, the ASX 100, the ASX 200. Like, we actually have an interest and a knowledge of much broader. So I think that's, an interest, really. I think that's been really, part of the kind of progression.
So if alternatives are, a certain part or an important part of a portfolio, the question is, how do we then go and build that portfolio? And you've suggested that an allocation of 30% to private equity, credit, real estate can improve returns, but also reduce volatility. Can you walk us through that thinking?
Sure. 30%. Don't know where that one came from, but
so came on research. You can say whatever percent you like.
Look, the percentage really depends on what type of an investor you are and what are your drivers. So, really, when you're thinking about the portfolio on a whole of portfolio basis, what are you thinking about? What are your liabilities? Do you have liabilities? Certain investors, defined benefit pension funds, have clear liabilities. They have to pay out a certain amount to their pensioners at a certain time until they die. So there's clear liabilities there. If you're an endowment and you've been gifted the money that sits in that endowment, usually it's just sitting there for capital preservation, and maybe there are some, whatever the donor wanted, they wanted, a new chemistry hall, lecture hall being built, then they will have some specific areas. But essentially, that money is sitting there to be preserved, and therefore it is a very long-term, it's a very long-term investment. As an individual, your time horizon might be shorter and more lumpy because you are working on an individual basis. You don't know what's going to happen. There's a lot more uncertainty. So therefore, the propensity to be allocated to, less liquid strategies that perhaps are harder to get out is clearly kind of limited. Let me give you some examples on this whole kind of spectrum. So endowments at the top, and David Swenson, I guess, is a name you're all familiar with, the godfather, do we call him, of the endowment model. He was the CIO of Yale University for many years. They would have around 60% allocated to alternatives, this really long time horizon. Sovereign wealth funds, so, Abu Dhabi Investment Authority, Future Fund, KIC in Korea, again, really long time horizons. What's their objective for investing? Usually to better the people of their country. So really long time horizon, they've not necessarily got income requirements or short-term kind of needs. So again, they will have 40-ish% in alternatives, perhaps 30 in privates, 10 in liquid alts. Then you get to pension funds. An Aussie super, they'd sit around a kind of 25% allocation to alternatives, give or take. And then you kind of jump into a next phase of ultra high net worth in the US as they kind of separate them, high net worth, and then, everyday retail investors. And that's where you kind of see the big kind of gap, partly because the parameters change massively in terms of what those investors are needing, maybe more heavily reliant on income, definitely more need for near-term liquidity. And they don't have the same access to resources that these first few bunch have. So big investment teams who can scour the universe, really do deep due diligence on managers and strategies and put it all together. So there's a lot more reliance in this bucket of wealth or retail around how they get that due diligence, how they outsource that, who provides the support there to enable them to feel comfortable allocating to alternatives. So, in the US, those groups are up to kind of a 10% on a kind of good, so some of the big kind of wirehouses, they'll have 10% allocations to alts, and their clients are comfortable with that. We're definitely not there in Australia, but the US is, and it's great for us that the US is further ahead because we will piggyback off this just in terms of their adoption of technology for individual investors, their ability to do custom personalized portfolios at the click of a button. So again, integrating technology to the creation of the portfolio, and then the adoption of alternative structures that they can then build into that. So we're getting there in Australia, but for kind of retail investors, I think kind of a 10% would be a really good starting point. But 60 is not, as long as you can kind of manage the illiquidity, or the liquidity comes a long way, we're going to kind of get this kind of convergent. it can be anywhere between those kind of bounds. Yeah.
So if 10% is the US and you say Australia's a fair way behind, do you have a ballpark of where Australia would be?
I don't know. Like, you can pick up different data on this.
Yeah, that's fair.
I mean,
Like
I would say sub 5.
Yeah, okay.
I
So
mean, we would like to think it's probably 5, but it's not realistically. And to be honest, that is just because there haven't been options. So there's been more liquid options. So risk premium, hedge fund-esque type strategies. That are pretty available in the market. We have one. And then there's...
Give it a plug. The
K to Athena fund. And then there's now, just really over the last year or so, the evolution of evergreen. Sorry, I shouldn't say the last year or so. It's been longer than that, but I guess it's just really now picking up in terms of a lot of offshore managers coming to market. The structures are now pretty well developed. Some of the issues that those early players had with mismatches between Australian structures and the UCITS structure or the Cayman structure that they were feeding into have kind of been washed out. So I think there's just now a lot more familiarity, a lot more clarity. We've now got service providers in Australia who are much more familiar with dealing with the structures. So we're going to see more of it. We're really at the start. And again, the more education and the more kind of immersion that we get within non-equity or fixed income equity markets, I think is just going to really help kind of accelerate this.
In some ways, it's interesting that Australia is so far behind because obviously in so many ways we lag the US, but we have these like really long duration assets in our super funds.
Yeah.
And like the self-managed super funds have become a lot more popular. Are you seeing an increased, allocation to alternatives, particularly in the SMSF space?
Yeah, definitely, and there's more familiarity there. Just basic things like having real estate sitting in that, that's often a reason why you'd come out of the super world and go into an SMSF. So I think the familiarity, and real estate is probably the easiest one, particularly for Aussies, to get their heads around.
Yes.
Super funds, they own airports, they own ports. We're not really getting to that, and that is just parcel size, that is just scale. Once we get to, again, the US is starting to do this, they are starting to, in the digital ecosystem, be able to fractionalize really large assets, timberland, agriculture, things that institutional investors have been investing in for many years, actually fractionalize those down, package them up into a token, can be traded on an exchange. Pretty easy to actually create the distributed ledger technology that sits behind that these days. That's actually not that hard. And then your parcel sizes are, sub 50K. So that is happening in the US. We're not there on that yet, but once that technology starts making its way across the water, then we'll see a massive shift, because that will open the alternatives. We talk about private equity and private debt and maybe hedge funds really as alternatives here, but royalty, it is going to expand massively. There's just so many more options with different characteristics and different drivers.
Just wait until they take that distributed ledger technology and apply it to Australian property.
100%. I'm with you on this. I'm totally with you on this.
God, that's going to go nuts.
Yes. Yeah.
As more and more options become available, how are you helping advisors think through about the allocation to each of the buckets available? So step one is, get the psyche around the fact that we need some alternative drivers and some alternative sources of return in the portfolio. Step two, dig into how you do that. So let me give you an example within private equity. So within private equity, that we use that as one bucket, but there is a plethora underneath there. And if you're comparing Canva, as I used the example before, that is like a late stage, that is kind of in a pre-IPO bucket, that would sit within a kind of crossover fund, versus I can't think of an example, but it's a real Australian startup. Equity Mates, perfect example.
Did I say capital was abundant?
Yeah, we're actually going to be asking you about that after this interview.
Big wind up.
So that is, do you call yourself early, mid-stage VC? But that is clearly in the venture bucket. You're looking, that is very, very different to a canvas. So even within that spectrum, then you've got, the buyout piece. So, are you looking at, sponsored, non-sponsored? Then you've got the secondaries piece. So then you've got in a lot of these private markets, we're now seeing secondaries markets develop. In private equity, that has been prevalent for well beyond 15 years now, 20 years even. So, once you get a secondaries market, you then get another liquidity source. So if large investors usually need to deallocate from their private equity programs because they need liquidity for some reason in their portfolio, maybe there's been, something's been going on with the currency and they need some liquidity to be able to support the collateral for their derivatives, then they might need to sell down a portion of their private equity program. That will go out into the secondaries market, and then that can be picked up, and then that can be packaged up and again introduced into the wealth market, which is exactly what we're doing with a fund that we have just launched within the last few weeks. So that's another strand of that private equity kind of spectrum. And if you looked at private debt, I mean, there's even more. And then you've obviously got geographies. So then you throw into that different geographies. So it's a really exciting. It's just a really exciting space to.
So Bryce asked, how do you help advisors navigate the space? And I feel like you've just absolutely overwhelmed me with the amount of choice in the space.
Okay.
So what? I guess where do you even start? Is it you want to have specific allocations to different subsectors, or is it purely like you're just looking for the best managers and you'll?
So I think clearly your advisor needs to be really well versed in what do you need as a client. What are you looking for? Are you looking for income? Are you looking for inflation protection? Are you looking for a kind of higher return, lower return, higher risk, lower risk? What exactly are your objectives? Not to your alternatives, just your general objectives. So your advisor needs a really clear understanding. What are your objectives? Why are they managing your wealth? What are they trying to get out of that? Once you kind of get that piece, then you start mapping. Well, if it's income, you're probably going to think about private debt, that is a income generative asset class rather than perhaps private equity, which is as you discussed earlier, more of a capital gains. So you kind of start there. You then think about what you're comfortable with. So perhaps real estate, as we've said, is perhaps more comfortable than US private debt or distressed lend. That stuff might sound a bit scary. So I think you just kind of start thinking about, well, where am I comfortable? How is it giving me something different to what I'm getting from my traditional portfolio? And then you just kind of build upon that. So I think, it's not scary. And as I described before with the Canva example, they're just, in private equity are just they're just companies that everyone knows in the public markets. Private debt's the same. It's just issuances of loans that would previously have been issued by banks, but because of all Basel III, all the capital requirements that are now put on banks since majority since the GFC, means that they don't want to issue those that anymore. So that's gone out to a non-bank lender. It's still the same. The loan is still going to the same place as it would have previously done from a bank. It's the same. What I'm trying to say is it sounds very complicated and there's a lot of jargon, I guess. But if you try and distill it to what am I actually investing in here, it is not that different to what you'd be investing in within your equity or fixed income.
Yeah. Of all the opportunities that are available at the moment, is there one particular sector or section that really excites you?
Well, you can tell I'm really excited by the whole space.
Yes.
I honestly, I've been working in hedge funds and alternatives, I've been working in them for 20 years, but really the last 10 years, really seriously. And I guess right now, this minute, private equity secondaries, which I mentioned, I think are really exciting. So there has been so much money going into private equity, as we discussed, and there haven't been many exits. So the exits have been a bit slow in coming. But that doesn't mean that investors don't need to reallocate their portfolios. Like a good example at the moment is endowments in the US. Trump is pulling back on funding to a number of the US universities. So they're having to, think about their kind of, their programs, and do they need a little bit more liquidity because they're going to have a little bit less coming in? How can they manage that when they've got such heavy private market programs? Well, they can put a slice of that private market program out to the secondary market. And that can be, they've got a driver for doing that. It's not because it's a bad program or a bad portfolio. It's just that they have other drivers that mean they need the liquidity more than anything else. So that can come into the secondary market and be really a really attractive pickup for a secondary manager to then pass on to to investors in Australia. So.
Nice.
Exciting. So if that's the I guess the subsector you're most excited about, I'm interested to know if there's any emerging subsectors. In Australia, it feels like the last few years we've lived through the emergence of private credit or private debt. Before that, there was obviously big pickups in private equity. Is there anything that's maybe nascent now, but if we reconvene in 3 or 5 years, it'll be something that's much more front of mind?
Yeah, I think definitely it has to be this digital tokenised space. So it's not really necessarily a new asset class. It's more of a new structure or how we will be able to access existing asset classes. So this point around, we have a money market fund in the US that is tokenized. It's called Benji, and essentially that provides access to just a cash fund. It's exchanged. You can instantaneously transact that within that fund. There's a yield attached to that fund. There's much lower costs associated than any other form of like a mutual kind of cash fund. That doesn't sound that exciting, but when you translate what you can do there with a cash fund, and you think, well, you can do that to all mutual funds, so equity funds, alternatives funds, real estate funds, private debt funds, and you can start chopping the funds up into much smaller parcels, putting them on a blockchain, and then being able to transact instantaneously at very, very low cost, have full transparency on those transactions. That is that's the next order.
I mean,
when it comes here, honestly, Alec,
I mean, the obvious question that comes out of that is does that, if that technology rolls out and it proves superior to what we have today, does that just make the exchange traded fund redundant?
Yeah, potentially. Yeah. Potentially.
Interesting. Now that would be disruptive.
Potentially.
Yeah. Well, I think to close it out, we started by asking, was the 60/40 portfolio dead?
Yep.
And you said, what are you guys talking about? It's been dead for years.
Never heard of it.
So I guess, if we stay in that mindset of if we're talking in 3 to 5 years from now, alternatives continue their rate of adoption and become much more a part of every investor's portfolio, what do you think will be saying the new 60/40 portfolio is?
Yeah, it's a good question. For a retail investor, there is no reason why it shouldn't be in that 20 to 30% range. There should be liquidity. These funds should be tradable. There's trade-offs for providing liquidity in these vehicles, but investors need to understand that. It is going to be a slightly different profile to what your Australian super is going to see from those assets, but that's part of the game. So absolutely no reason why it shouldn't be up in that 20-30% at all.
Nice.
60/40 is dead. Long live 50-25-25.
You got it.
Not quite as catchy, but we'll push it.
Well, Felicity, I'm certainly excited about the opportunity, albeit a little bit out of reach at the moment. Looking forward to some of those trends coming through. Thank you so much. We really appreciate your time.
Thank you. Really appreciate it. Thank you.